Okay. Good morning, friends. Okay, let's continue with capital budgeting. In the last class, we had started with risk analysis in capital budgeting. The capital budgeting analysis comprises of two components. One is normal capital budgeting analysis, which you learnt as part of CA Inter. That's what you learnt in CA Inter. Then the second part is called as risk analysis in capital budgeting. In risk analysis in capital budgeting, we evaluate from a risk point of view. How do we evaluate various projects from the point of view of risk? In that, first we learned how do I calculate standard deviation. Standard deviation was nothing but whatever we learnt in portfolio chapter. We used to in portfolio chapter write return, probability, product, deviation. Here NPV, probability, product, deviation and PD square. Compute standard deviation, compute expected NPV. We also learnt about calculation of something called as coefficient of variation. Then we went ahead and saw two more concepts. One is RADR, which says the discount rate for different projects will be different, and the discount rate would depend on the riskiness of the project. High risk project will have a higher discount rate and low risk project will have a lower discount rate. Uncertainty equivalent factor says that your uncertain cash flows can be converted into something called as certain cash flows by multiplying them with CEF. Today we are going to start with something called as sensitivity analysis. So we'll start with sensitivity analysis. Now listen. I have started with a project. I did the NPV calculation. Okay, looks to be a good project. NPV is 2 lakh rupees. We went ahead, we did. Now this NPV is influenced by multiple factors: outflow, revenues, cost, discount rate, life, salvage value, working capital. There are multiple parameters which go into the calculation of NPV. What sensitivity analysis basically tells us, what is the tolerable limit for changing these variables. For example, if outflow increases by more than 2 lakh rupees, if outflow increases by more than 2 lakh rupees, NPV will become negative. NPV will become negative, project will get rejected. So we are finding out what is the tolerable limit of the change of the various variables which are there. It could be outflow, it could be selling price, it could be unit sold, it could be cost price, variable cost, fixed cost, discount rate, life. Any of the parameters can be there which goes into the computation of NPV. What goes into the computation of NPV is initial outflow, in between flow, terminal flow, life, discount rate. Any of this can change. If any of these variables undergo, only one at a time, we don't look at multiple variables at a time, one at a time. So what is if I only say sensitivity of outflow is 15%. Now what does that 15% mean is outflow can increase by 15%. I don't have a problem. But if it increases by more than 15%, project is rejected. If it increases by more than 15%, project is rejected. You will not call it as 2 lakh rupees, you will call it in percentages. Similarly, selling price can fall by 10%. The selling price of the company can fall by 10%. The revenues, the units sold can decrease by 10%. So different variables, you find out what is the tolerable limit of adverse variation. No favorable variance, only adverse variance, that is outflow going up, revenues coming down, cost going up, discount rate going up, life coming down, salvage value come down. Anything which is going to negatively impact the NPV. We are only worried about anything which is going to negatively impact the NPV. So the formula for sensitivity is change by base into 100. For example, we said 2 lakh. 2 lakh wouldn't make any sense to me. I'll write it as 2 lakh divided by original investment of 10 lakh. 2 lakh divided by 10 lakh into 100. So that I'm indirectly telling outflow sensitivity is 20% and outflow can increase by 20%. If it increases beyond 20%, project is rejected. Now in a practical world, it will not be one parameter at a time. Multiple things can change, but from a problem point of view, you take one at a time and do the analysis. Yeah. Outflow, no? Outflow is day 0, no? Outflow is day Yeah, everything will be present values only. All you will have to take present values only. Outflow is day 0 figure. So the formula is changed by base into 100. Now if somebody wants to know sensitivity for selling price, I will have to first find at what selling price will we generate 0 NPV. At what selling price are we going to generate 0 NPV? So at 10 rupees I am generating positive 2 lakh. At maybe 8 rupees I generate 0 NPV. Then formula is change 10 minus 8, base is 10 into 100. Again you have a sensitivity of 20%. Like this you will compute the sensitivity percentage. Any factor which has the lowest sensitive percentage, that's the most important factor for the success of the project, because if the sensitivity is very less, even a small change will lead to rejection of the project. So you will have to be extremely careful in predicting that item. That item we should be 100% certain that we will get only that figure. My outflow will be only 10 lakhs. I have no doubt it will not go up significantly, it will not come down significantly. So we will have to have better clarity on items whose sensitivity percentage is very less. So the basic objective is finding out something called as, first originally we will compute NPV and then we will try to find out at what level are we going to have 0 NPV. That's the basic requirement. At what level are we going to have 0 NPV? Find that, then use the formula called as change by base into 100. Let's get to question 1. Red Limited is considering a project with the following cash flows: year, cost, recurring cost, savings. Cost of capital is 9%. Measure the sensitivity to the changes in plant value, running cost and savings such that the NPV becomes 0. Which factor is most sensitive to affect the acceptability of the project? Okay, now see, I'll normally calculate the NPV. The format for NPV is year, cash flow, PVF, DCF. Now this cash flow which we write, now listen for some time. I will split the cash flow into multiple numbers. What will be the multiple numbers is for whatever you want to calculate the sensitivity. So plant value will be one of the columns, running cost will be second column, savings will be third column. Why do I calculate separately? I would like to know the present value of all the items. So if somebody says measure sensitivity on selling price will be captured separately. Cost will be captured separately. You capture multiple items separately. The reason for capturing them separately is it makes it easier to compute sensitivity percentage. Can I do it together and then try to measure sensitivity? Yes, you can do it together also. You are going to get the same answer. So we are going to measure, first calculate NPV, but NPV computation would be split into various subcolumns. Working note 1, computation of NPV of Red Limited. 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 Year, cash flow will be split into 3 in this question. The cash flow will be split as plant value plant value, recurring cost, savings. Year cash flow split as 3: plant value, recurring cost and savings. PVF at 9%. DCF again 3 subcolumns. Now, if I want, I need not split it, but if I don't split it, then at every stage I'll have to do this calculation again. So we may have to do this calculation multiple times. How many years is the project? 2 or 3? Okay, 2. So 0, 1, 2, 0, 1, 2. What is the plant value? Minus 10,000. Nothing changes. Plus minus, all rules remain same. Just that you write it as multiple line items, multiple columns. Minus 10,000. What's the recurring cost? Minus 4,000 and minus 5,000. Year 0, nothing is there. Minus 4 and minus 5. Minus 4,000, minus 5,000. Savings 12,000 and 14,000. 12,000 and 14,000. and 14,000. Your rules for DCF computation remain same. There's a reason why we don't club it. Even if I club and compute NPV, NPV will remain same. My NPV will not undergo a change. NPV is anyway going to remain same whether I club and do it, whether I do it separately. That doesn't really matter. We can club and do it, we can do it separately. Finally, you can add those 3 items. This is the NPV we generate, 4914. The NPV which the project generates is 4,914. Which one? Adding the 3 items, minus 10, minus 7, plus 22. Any doubts on this? NPV is 4914. Clear? Can we proceed? Okay, now listen. We are going to do the answer, but listen. My NPV can become 0 if the initial plant value, the multiple factors, my NPV can become 0 if the initial plant value increases by 4914. If the initial plant value increases by 4914, NPV will turn out to be 0. So that is one way of measuring the sensitivity for plant value. This can become 0 if the present value of recurring cost goes up by 4914. If the present value of recurring cost goes up by 4914, again it becomes 0. This can also become 0 if the savings come down by 4914. If the savings come down by 4914, so the formula is change by base into 100 for sensitivity. Change for all the three parameters is 4914. Base for the first parameter is 10,000. Second parameter is 7878. Third parameter is 22,792. Basically, we are telling how much cushion is there in the company to absorb any adverse variation. What is adverse variation? Is cost going up and revenues coming down or savings coming down. Now write sensitivity analysis for plant value. Sensitivity analysis for plant value. Sensitivity analysis for plant value. Point number A, the company currently earns NPV of 4914. Company currently earns NPV of 4914. Currently earns NPV of 4914. Full stop. This will become 0. This will become 0 if initial outflow increases by 4914. If initial outflow increases by 4914. If initial outflow increases by 4914. Now write sensitivity percentage equal to change by base into 100. Sensitivity percentage is equal to change by base into 100. Change by base into 100. In change you will write 4914 and base is 10,000. Change is 4914, base is 10,000. I am indirectly telling the project has a cushion to absorb a 49% increase in cost. But if the cost goes beyond 49%, project is rejected. If the increase is beyond 49%, project will get rejected. Any doubts on this? Next, sensitivity analysis for recurring cost. Sensitivity analysis for recurring cost. Below that, the present value of recurring cost is 7878. Present value of recurring cost is 7878. Is 7878. Is 7878. Full stop. The project will generate 0 NPV. The project will generate 0 NPV if the present value of recurring cost, if the present value of recurring cost increases, if the present value of recurring cost increases by 4914, if the present value of recurring cost increases by 4914. Any doubts in this? Present value of recurring cost increases by 4914. Now sensitivity percentage equal to change by base into 100. change by base. Everything has to be present value. You cannot do a normal addition of cash flows. 4914 by 7878, 62.38%. Now listen, the 62.38, no, it's basically for both the years. It's uniform increase. Listen for a minute. I had this 4,000, I'm increasing it by 62.38%. The next one also, I will increase it by 62.38%. We will broadly get a 0 NPV except for the rounding of differences, minus 0.29. So my project can absorb a 62% increase in recurring cost. For both the years, I am working with the same number. I cannot say first year so much, second year so much. That my sensitivity percentage can't tell. So I am indirectly telling them, okay, if outflow increases by 62.38%, don't worry about it. But sensitivity is one factor at a time. Now you cannot say that there will be a 10% in plant value and a 20% here. Together it can't take into consideration. It is one factor at a time. Clear? Any doubts on this? Next, sensitivity percentage for savings. Sensitivity percentage for savings. The present value of savings is, the present value of savings is 22792. Present value of savings is 22792. 22792. Full stop. The project will generate 0 NPV. Project will generate 0 NPV if, will generate 0 NPV if present value of savings reduce, if present value of savings reduced by rupees 4914. If present value of savings reduced by rupees 4914. Reduced by rupees 4914. Sensitivity percentage equal to change by base into 100. Sensitivity percentage is equal to change by base into 100. Change by base into 100. Change by base into 100. 4914 by 22792 into 100. This is available cushion in the company. That much fall the company can easily absorb. But if the fall happens beyond that, project can't take that into consideration. It can absorb till that. It can absorb a 21.56% fall. When it falls by 21.56, you generate 0 NPV. You generate 0 NPV. So that is what we are basically measuring in sensitivity. How much cushion is there in the project to absorb adverse movement, only adverse movement, no favorable movement. I cannot say that savings will go up. That and all sensitivity can't take into consideration. Sensitivity is basically how sensitive is our decision to the changes in the various parameters. And when in a practical world also, whenever I am doing a loan proposal, I'll have to do sensitivity analysis, and sensitivity is always on the negative side. You'll only analyze the negative side of the story, not positive side. Now write the project is most sensitive. The project is most sensitive to savings factor. The project is most sensitive to savings factor. Is most sensitive to savings factor. Most sensitive to savings factor. To savings factor, as the same has lowest sensitivity percentage. As the same has lowest sensitivity percentage. As the same has lowest sensitivity percentage. Same as lowest sensitivity percentage. Now listen. if you see here, I have these three percentages. Now, if there is a 25% increase in initial outflow, project will still be accepted. If there is an increase in cost by 25%, project will still be accepted. But if there is a fall by 25% in savings, project will get rejected. The project is most sensitive to savings factor. It cannot absorb a 25% drop in savings, but it can absorb a 25% increase in initial outflow or the recurring cost. Clear? Any doubts on this? Done? Let's move to question 2. Then that's called a scenario analysis. There's something called a scenario analysis. So I give you multiple scenario, you end up doing the NPV in the normal manner and then say, so I need not give even a term called a scenario analysis. It's basically reworking the NPV. You do your year, cash flow, PVF, DCF, you see whatever changes, compute the NPV, positive, go ahead, negative, reject it. Yes, practical world will be two factors at a time. It can't be a single factor. Correct. Correct. So if there is a 25% drop, the first and second will absorb it, will be okay. The first and second factor, a 25% variation is okay with plant value, okay with recurring cost, but not okay with savings. But not okay with savings. Go through question 2. Okay, the same similar scenario, there's an initial outflow, there's a selling price given, there's a cost price. I am required to measure the sensitivity for selling price, cost price, sales value, initial outlay and project lifetime. I'll explain what is to be done with project lifetime in some time. Let's first compute the NPV using the same structure. Working note 1, computation of NPV of ABC Limited. Computation of NPV of ABC Limited. NPV of ABC Limited. Year. Cash flow will have 3 columns. Initial outflow, sales and cost. 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 See, totally they have asked for 5 factors: selling price, unit cost, initial outlay, sales values. There we'll see what is the difference. Is there any difference between selling price and sales value? And project lifetime. Project lifetime will be done separately. We'll see that later. As of now, I'll get answer to 4 factors using this table: selling price, unit cost, sales value, initial outlay, project lifetime. Year, 0, 1, 2, 3, cash flow, initial outlay sales cost, PVF, DCF, initial outlay sales cost. You split into 3 sub columns, create the format and keep it ready. Initial outlay sales cost, initial outflow sales cost. Okay, let's start. What is the initial outflow? 10 lakhs. Initial outflow is 10 lakhs. Sales for the first year 20,000 into 60. Second year 30,000 into 60 and again 30,000 into 60. 20,000 into 60, 30,000 into 60 and 30,000 into 60. Cost, you will write it in negative. What's the cost price per unit? 40. So minus 20,000 into 40 minus 30,000 into 40 and minus 30,000 into 40. If this base table is done, we'll start discussing the question. It's the normal NPV calculation, just that I write it as 3-4 different line items and do. It becomes easier for us to compute those sensitivity percentages. Done? Can we discuss? Okay, now listen. See, I am generating an NPV of 3,09,800 because of 3 factors. One is there's an initial outflow, there's a sales, there's a cost. These 3 factors, if outflow goes up, NPV will come down. If sales come down, NPV will come down. If cost goes up, NPV will come down. So there is going to be an impact of NPV at every level. Now, the formula is going to be changed by base into 100. Change is 309,800. For any parameter you take which can be expressed in rupees. For example, there is a parameter called as discount rate. For that, change can't be 309,800. Any parameter which can be expressed in rupees, There will be a parameter called as life. Life can't have a change as 309,800. Any parameter which can be expressed in rupees. What can be expressed in rupees? Anything. Initial outflow, selling price, cost price, salvage value. Lot of factors can be expressed in rupees. So the change for selling price is going to be 30800. Unit cost is going to be 30800. Sales value is going to be 30800. Initial outlay is going to be 30800. Base is what we are going to discuss. Selling price, what will be the base? If selling price is the parameter to be taken, what will be the base? Think and then participate. Let's discuss on selling price and sales value, these two alone. What should be the base for selling price and what should be the base for sales value? Is the change. No, then see, if your numerator is in rupees, denominator should also be in rupees. If you are saying numerator is 309,800 rupees, then you cannot say me my denominator will be units. Oh, no, that will not work out because the units are different at 3 years. Then I'll have to get something called as present value of number of units. So what should be the base for selling price and what should be the base for sales value? I want participation.
Sales value, the total sales value.
Okay.
1, 2, 3. You are already having the sales value.
3929400. Okay.
So the 309,800 by the total of that.
Okay, that's for sales value.
Yeah.
And selling price? No. So I'll tell you now, listen. The base for selling price will be 3929,400. Why 3929,400 is this is the value of the sales of all units. This is the value. If it is sales value, the point is when it is sales value, the hidden adjustment is if my sales value comes down, my cost will also come down. If my sales value comes down, because sales value can come down because of two things. One is selling price, second is units sold. Now it can't be because of selling price because selling price is a separate parameter altogether. So listen, for selling price the base is going to be sales. For sales value the base is going to be profit. What is profit? Is sales minus cost. Profit is sales minus cost. If the sales value is the parameter, because I cannot say that my sales value has to only come down by 309,800. The issue is if sales value come down by 309,800, the cost value will also come down along with that. When the parameter is sales value, it's technically, they should have worded it better. Instead of giving sales value, this is nothing but sales units. This is nothing but sales units. So if sales units are coming down, cost value will also come down. Listen, so what I am trying to say is, if it is a selling price parameter, this should come down by 309,800. This should come down by 309,800. That is, every year you reduce the selling price, every year the value comes down, overall 309,800 is the reduction. But if it is sales value, it can't come down by 309,800. It has to come down by a higher number. Why a higher number? Because cost also parallelly comes down. Cost is also parallelly reducing because when units come down, cost is also going to come down. So I should have another parameter which you need not write, but there's another parameter called as profit. What is that is? So this 1309,800 has to come down to 10 lakhs. This 1309,800 has to come down to 10 lakhs. The moment that comes down to 10 lakh, you will have 0 NPV because your outlay is 10 lakh. So selling price, the denominator is sales value. Unit cost, the denominator is cost value. Initial outlay, the denominator is initial outflow. But for sales units, not value, it's not value technically, it is sales units. For sales units, the denominator is profit, or the denominator is present value of in between cash flow. Present value of in between cash flow. We will do every parameter. I'll show you the verification by changing the numbers. We'll do every parameter and I'll also show you the verification by changing each of the numbers. Any doubts on this?
Sales value generally will take the sales that we discounted.
Correct. How will sales value come down? When can sales value come down? Either there is a reduction in selling price or reduction in number of units. Now I cannot say selling price because selling price is a separate parameter. I have one parameter, the first parameter itself is selling price. The first parameter is selling price. The issue is fall in selling price is more severe than fall in units, because when selling price falls, your profit will exactly fall by that number. But when units are falling, parallelly cost also comes down. So that is kind of a benefit for the company. So somebody says my selling price is going to reduce, so the maximum sensitivity will always be for the selling price parameter, because that is the most crucial one. Because if selling price falls, the profit will exactly fall by the same number. But if units are falling, sales will fall because of the units, but profit impact will. If my units falls and sales fall by 2 lakh rupees, profit will not fall by 2 lakh rupees. Profit will fall only by 40,000. Why 40,000? Because cost also come down parallelly. Now I cannot say that sales value means selling price, which is not a good assumption, because already I have a separate parameter. Clear? Any doubts on this? Now computation of sensitivity percentages. Point number A, sales price. Point number A, sales price. Point number A, sales price. Right, the present value of sales inflow. The present value of sales inflow is rupees 39,29,400. Is rupees 39,29,000. I'll write this detailed explanation. I'll show the verification. Then things will become clearer. Is rupees 39,29,400. Full stop. The NPV will become 0. The NPV will become 0. NPV will become 0 if the present value of this, if the present value of sales, the NPV will become 0 if the present value of sales, come down by 309,800. If the present value of sales come down by 309,800, sensitivity percentage equal to change by base into 100. Change by base into 100. Change by base into 100. 309,800 by 39,29,400. 309,800 by 39,29,400 into 100. What's the sensitivity percentage? 7.88%. 7.88%. Clear? Any doubts on this? Okay, now for your better understanding, write the next point. Break even selling price equal to break even is basically the price at which you will generate 0 NPV. Break even selling price is equal to 60 minus 7.88%. 60 rupees minus 7.88%. 60 rupees minus 7.88%. 60 rupees minus 7.88%. What's the selling price you generate? 55. Okay, 55. Now listen. This is for your understanding. If I put 55.27, I'll get 0 NPV. If I get, my answer is right, because the sensitivity for selling price, I said if selling price falls by 7.88%, project is 0. More than that, project gets rejected. So 55.27, I generate 0 NPV. The NPV of 32 is more of rounding of difference. So we are generating 0 NPV if selling price falls by 7.88%. Any doubts on this? Next, parameter 2, unit cost. Parameter 2, unit cost. now, right? The present value of outflow for cost. The present value of outflow for cost is 26,19,600. Present value of outflow for cost is 26,19,600. Value of outflow for cost is 26,19,600. Any doubts on this? Full stop. The project will generate 0 NPV. Project will generate 0 NPV. Project will generate 0 NPV if PV of outflow increases by 26,19,600. If PV of outflow increases by 26,19,600. PV of outflow increases by 26,19,600. PV of outflow increases by 309,800. If PV of outflow increases by 309,800, sensitivity percentage is changed by base into 100. Change by base into 100. Now break even cost price is 40 rupees plus this. Break even cost price is 40 rupees plus this. Break even cost price is 40 rupees plus this number. 40 rupees plus 11.83%. I'll break even if the cost goes up by 11.83%. Anything beyond that, rejection. 40 plus 11.83%. How much? 44.73. Okay. So if we do 44.73, we get again 0 NPV. 44.73 gives us 0 NPV. Any doubts on this? Any doubts on 44.73? See, the thing is, if cost price increases, it will impact only that. If selling price changes, it will impact only that. Next, sales value. Sales value below that, point number 1, it is assumed that change in sales value arises due to units, full stop. If the units change, then both PV of sales and PV of cost, then both PV of sales and PV of cost will change. Both PV of sales and PV of cost will change. PV of sales and PV of cost will change. Next, present value of net cash flow equal to present value of net cash flow equal to present value of net cash flow equal to net cash flow equal to net cash flow equal to present value of revenues minus present value of cost. present value of revenues minus present value of cost. Present value of revenues minus present value of cost. Revenues minus present value of cost. Subtract that. Present value of revenues minus present value of cost. 39,29,400 minus 26,19,600. 39,29,400 minus 26,19,600. We get it as 13,09,800. 13,09,800. Any doubts on this? 13,09,800. Next point, NPV will become 0. NPV will become 0. NPV will become 0 if the net cash flow. NPV will become 0 if the net cash flow falls by 309,800. If the net cash flow falls by 309,800. Falls by 309,800. Falls by 309,800. Falls by 309,800. Sensitivity percentage is equal to change by base into 100. Base is 13,09,800. Change by base into 100. Change by base into 100. Change by base into 100. 309,800 by 13,09,800. 309,800 by 13,09,800 into 100. 309,800 by 13,09,800. Any doubts on this? Okay, now listen. The answer is 23.65%. This is for your verification purpose. Listen. I had sold these units 20, 30 and 30. I am changing them by 23.65%, which will become 15,270 and 22,905, 22,905. If I reduce it by 23.65%, so this year they will sell 15,270 units. This year 22,905 and again 22,905. The problem is, along with that, this also changes. This also changes, and we get a 0 NPV. 15,270, 22,905. We end up getting a 0 NPV. So again there is a 0 NPV. When I put a total of all of this, I'll end up getting a 0 NPV. Any doubts on this? Any doubts on this? Units will fall, but along with units fall, cost is also going to fall. Cost is also going to fall. Any doubts on this? Any doubts on this part? Clear? Next one is easy. Sensitivity percentage for initial outlay. You write it. Sensitivity percentage for initial outlay. For initial outlay. Sensitivity percentage for initial outlay. For initial outlay. Change by base into 100. change by base in 200, change is 309,800, base is how much? 10 lakhs, and sensitivity is 30.98%. Sensitivity is 30.98%. Any doubts on this? So for selling price 7.88%, cost price 11.83, units 23.65, initial outflow 30.98. Any doubts till this? Any doubts? Can we proceed? The only thing which is pending is lifetime. How do I do this project lifetime? I want to know at what life will we have 0 NPV. To do a sensitivity, basically we want to know at what life will we have 0 NPV. How do I calculate that? At what life are we going to have 0 NPV? See, at what selling price are we going to have 0 NPV? We calculated, I wrote break even selling price. At what unit cost we will have 0 NPV? Again we wrote. At what unit sold? Again we calculated. Initial outlay we have calculated.
So we do this right. For example, the first year we are getting this much NPV, this much total inflow. Second year we are getting this much inflow. Additional inflow proportionately.
So what is the technically called? Tell me the technical name. Okay, we'll compute something called as discounted payback. Discounted payback tells the number of years in which you recover your initial investment. Discounted payback tells the number of years in which you recover your initial investment. So on the date of discounted payback period, the NPV is 0. Beyond the discounted payback, you make profits. So the discounted payback refers to the number of years in which you recover your initial investment. It also refers to the number of years in which you generate your 0 NPV. Clear? Now, to do discounted payback, we'll do it in a different format. Working note 2, computation of discounted payback. Computation of discounted payback. Computation of discounted payback. Year, cash flow, no separate columns and all, we'll have to link, we'll have to combine everything. Year, cash flow, PVF, DCF, cumulative DCF. Year, cash flow, PVF, DCF and CDCF. Year, cash flow, PVF, DCF and CDCF. You copy the cash flow numbers, net, adding, subtracting, everything. No separate items called as outflow, inflow, all that you combine and tell me the cash flow number. We had split, that split and all is not needed now onwards. We need not split the cash flows now. Year cash flow. Cash flow is outflow, sales, cost all combined together. Outflow, sales and cost all combined together, you will get the cash flow number. We have already done this in basics. Computation of discounted payback. Computation of, you complete this, I'll again take you through the formula. Discounted payback. it's normal NPV computation. We have another column called as CDCF. Now discounted payback equal to, we've already done this, discounted payback equal to base year plus unrecovered cash flow of base year divided by discounted cash flow of next year. Base year plus unrecovered cash flow of base year divided by discounted cash flow of next year. Base year refers to the last year in which cumulative cash flow is negative. Year 0 negative, year 1 negative, year 2 negative. So that's the base year. Year 3 it becomes positive. 2 plus unrecovered cash flow is 140,800 and cash flow of next year is discounted cash flow 450,600. How much? We normally convert the second part into months. It's not needed here. Here it will just end with 2.31 years. 2 plus 140,800, which is the unrecovered cash flow. How much negative it is in that year, divided by the discounted cash flow of next year. 2.31 years. 2 plus 140,800 by 450,600. 2 plus 140,800 divided by 450,600. 140,800 divided by 4,50,600. 4,50,600. Two plus 140,800, 450,600. You get finally 2.31 years. Any doubts on the discounted payback? 2.31 years. Clear? Can we proceed? Now sensitivity percentage equal to, sensitivity percentage equal to changes from 3 years falling to 2.31, 3 minus 2.31, base is 3 years into 100, change by base into 100. If life falls to 2.31 year, we will generate 0 NPV. 3 minus 2.31 divided by base of 3 years into 100. See, the only rule is change and base should be in the same unit. If changes in if changes in years, base should be in years. If changes in rupees, base should be rupees. If changes in selling price, base should also be selling price per unit, at a per unit. So whatever way you are measuring, you will have to continue with the same way. The answer is 23%. So we can accommodate a 23% fall in life. We can accommodate a 23% fall in life. They have just asked for the sensitivity. They have not asked us to give comments. The most sensitive one is selling price. So I will have to be very clear on the selling price. Will it sustain at 60 or not? If I have doubts on that 60 rupees, I may not do this project. Because even if it falls by some 8%, project is gone. You will have to reject the project. If selling price falls by 8%, project is rejected. So we will have to be extremely careful in the estimation of the selling price. Units and all, even if 10% come down, 15% come down, we can accommodate. But selling price, I cannot accommodate a fall more than 7.88%. Any doubts in this? Clear? Okay, now listen. The formula is change by base into 100. Listen. The formula is change by base into 100. Change and base should be in the same unit of measure. If change is in minutes, base should be in minutes. If change is in years, base should be years. If change is in percentage, base should also be a percentage. When it can be percentage, discount rate. If change is in percentage, base should also be percentage. So both have to be for the same unit of measure. If anything, any base is going to be in rupees, then the change for that will be NPV. Then the change for that will be NPV. For anything which can be expressed in rupees, I cannot express life in rupees. Anything which can be expressed in rupees, For that, the base will be that element and change will be amount of NPV. Change will be amount of NPV. That is why we do 3-4 separate calculations so that I get those present values. I get those present value because change is going to be 309,800. Base will be different across places. Clear? Any doubts on this? Let's do question 3. Go through the question. Go through question 3. Okay, let's look into the question. Easygoing Company Limited is considering a new project. IRR is 16%. Financial manager has estimated that he has given us two sensitivity. Fixed cost, if it increases by 7.8416%, project will generate 0 NPV. Fixed cost increases by 7.8416%. And if cost of capital increases by 60%, project will again generate 0 NPV. Other information, calculate initial investment, NPV, fixed cost, annual unit sales, break even. So it's a reverse working problem. Tell me, how do I start this problem? What should be the starting point? We have PV. Okay. Okay, so let me write this. This is 30%. Okay. Okay, selling price is 200 then. Selling price is 200. What will I do beyond this? Okay.
I'm assuming that that's a net cash flow.
Correct.
So my net cash flow is nothing but my 70 rupees.
140 rupees. But there is a fixed cost also, no?
So
There is a fixed cost element as well, no?
profit, that's why I'm getting my contribution effect.
Contribution, how many units? Where do you have units? Okay. Annual cash flow is 57,500. Okay. You will discount at what rate? Not, yeah, it's IRR, not maybe IRR. We'll discount at IRR. So IRR is the rate of return at which NPV of the project is 0. So let's get the initial investment. That is done. I'll get the initial investment. See, IRR is the rate of return at which NPV of the project is 0. That does not mean NPV is 0. IRR is the rate of return at which NPV of the project is 0. So using the IRR rate, we are going to compute initial investment. Again, I am repeating you, that does not mean NPV is 0. Working note 1, computation of initial investment. Working note 1, computation of initial investment. Computation of initial investment. Now write IRR is the rate of return. IRR is the rate of return at which NPV of the project is 0. IRR is the rate of return at which NPV of the project is 0. Year cash flow PVF at 16%, DCF. Year cash flow PVF at 16%, DCF. PVF at 16%, DCF. Is there any salvage value given in the question? Or if nothing is given, we'll ignore salvage value. So year cash flow PVF at 16%. You know the cash flow. Cash flow is reverse work and get the initial outflow. I'll come in a minute. What's the PVF at 16%? 5 year? 1 lakh?
88,200.
And the factor was 3 point? Sorry. 188 274. Okay, ठीक है, around 188 is the answer. 1,88,272. That's my initial outflow. My initial outflow is around 1,88,270. Initial outflow is 1,88,270. Any doubts on this? Any doubts on the initial outlay number? 1,88,270. So we are done with one part of the question. My initial investment is 1,88,270. I cannot say that NPV is 0. That's not the right approach. NPV is not 0. 188,270. Any doubts on that? Okay, what should we do next?
Cost of capital, KE.
So how will you find? What do you want me to do?
So we have to change sensitivity 60%.
Okay.
For base by change into 100 is 60% yes.
Okay.
So the KE probably we have this perpetuity.
Done. Understood.
We have a perpetuity formula wherein KE is equals to cash flow divided by
No perpetuity. No perpetuity. Okay, now listen. Any sensitivity percentage basically will tell you at what level there will be a 0 NPV. My original cost of capital is X. I don't know this rate, okay? Post increase, revised cost is 1.6x. Revised cost is 1.6x. The original discount rate is X percentage. The revised discount rate is 1.6x. At 1.6x, I'll generate 0 NPV. At 1.6x, I'll generate 0 NPV, and that 1.6x is 16% of IRR. At 1.6x, we will generate 0 NPV, and that 1.6x is the IRR of 16%, because IRR is given in the question. Clear? Any doubts on this? Next point, computation of cost of capital. Computation of cost of capital. Computation of cost of capital. Let us assume the original discount rate. Let us assume the original discount rate to be X. Original discount rate to be X. Next point. The sensitivity percentage for cost of capital. The sensitivity percentage for cost of capital is 60%. For cost of capital is 60%. For cost of capital is 60%. And hence the project will generate. And hence the project will generate 0 NPV. Project will generate 0 NPV. Project will generate 0 NPV at a discount rate of 1.6x. At a discount rate of 1.6x. Any doubts on this? Next, IRR is 16%. IRR is 16%. And hence 1.6x is equal to 16%. And hence 1.6x is equal to 16%. 1.6x is equal to 16%. Cost of capital is 10%. Cost of capital is 10%. Any doubts on this? Any doubts on the cost of capital number? Clear? Any doubts on this? Next, working note 3, computation of NPV. It's not 0 NPV. Now only we will calculate the NPV. Working note 3, computation of NPV.
The base year is 10%.
Which one?
The base year is 10%.
Correct. Base is the original, no? Computation of NPV, year, cash flow, PVF at 10% and DCF. Year, cash flow, PVF at 10% and DCF. What was the outflow we had calculated? 188. 125 was the project is generating a decent amount of NPV. Some 29,000 of NPV is being generated by the project. $29,713. The NPV of the project is 29,713. NPV is 29713. $29,713. Any doubts on this? Can we proceed? Okay. So I have done with two parts of the question. Initial investment is done, net present value is done. How do I proceed beyond this? Okay. So how do you want me to use that?
In the sense like after I get my contribution,
Hmm.
I had my fixed cost. After reducing the fixed cost, I will be getting my net profit. So if I take this fixed cost sensitivity, my net profit will be 0.
Okay. So okay, done. I understand all of that. How do you want me to proceed?
So here, what we do is, I have my contribution as 140.
Understood.
Let's take example, my fixed cost is X.
Okay.
Therefore, profit will be by contribution minus X, which is 140 minus X.
It's not 140. 140 number of units.
Per unit.
So, but per unit you can.
Fixed cost is, you can't apportionate on the unit basis.
Correct.
So it's 140
Into what?
57,500 is nothing but my annual income, which is nothing but my profit.
I understand.
So plus X I'll be doing in order to get my contribution.
Understood.
So divided by 140, I'll get number of units.
You cannot. No, that's again. You need at least one of the two numbers. No, you cannot have two items in terms of X. No. Okay. Now listen. I currently have this bit of calculation done. Now what I am going to do is I am going to calculate the cash flow. That is this table which is there. No, this 57,500 you replace that. You will find some number. That number basically indicates a 0 NPV. That number basically indicates a 0 NPV. Listen for some time. I'm going to find some number in place of this which will generate a 0 NPV, which is going to generate a 0 NPV. As of now, contribution minus fixed cost is 57,500. Okay, contribution minus fixed cost is 57,500. Then contribution minus, what is the sensitivity percentage? 107.8416 percentage of fixed cost is equal to one number. Contribution minus 107.8416 percentage of fixed cost is equal to one number. What does that number is this? Because you are going to find out at what cash flow are we going to generate 0 NPV. At what cash flow are we going to generate 0 NPV. So when I analyze that, I only consider that parameter into consideration, ignoring the other aspects. So next, right, working note 4, computation of fixed cost. Computation of fixed cost. Computation of fixed cost. Now, right, let us first find the annual cash flow. Let us first find the annual cash flow. Let us first find the annual cash flow at which, first find the annual cash flow at which the project will have 0 NPV. Let us first find the annual cash flow at which the project will have 0 NPV. Project will have 0 NPV. Year cash flow PVF at 10%, DCF 0, 1 to 5, let us first find the annual cash flow at which will have 0 NPV. Any doubts on this? Okay, now listen. See, originally what we did was contribution minus fixed cost was 57,500. This was the original calculation. Now contribution minus 107.8416 percentage of fixed cost is equal to 49662. Contribution minus 107.841. What is sensitivity? Sensitivity basically will tell you at what level are we going to have 0 NPV. Now you need not do all of this. I'll tell you a shorter way. This and this gets cancelled. You will be left with 7.8416 percentage of fixed cost is equal to, what's the difference? 49662, 7838, 7838. Now listen, I'm not going to tell you to do this. What I'm going to write is the fixed cost will increase by 7.8416% and that will lead to a fall in annual cash flow. The first point which we are going to write, listen for some time. The fixed cost will increase by 7.8416% and the annual cash flow will fall. Next point, the fall in annual cash flow is 7838 and the same is equal to 7.8416 percentage of fixed cost, and we get the fixed cost number. We get the fixed cost number. Able to understand this? At one point of time you will take only a single parameter, not taking two parameters at a time. Now write point number 1. Point number 1. The annual cash flow has to fall from 57,500 to 57,500 to 49,662. Has to fall from 57,500 to 49,662. 49,662 for a 0 NPV. To 49,662 for a 0 NPV. Full stop. The amount of reduction in annual cash flow is 7838 is 7838 in bracket 57,500 minus 49,662. 57,500 minus 49,662. 57,500 minus 49,662. Clear? Next point. Fixed cost has to increase. Fixed cost has to increase by 7.8416%. Has to increase by 7.8416%. Has to increase by 7.8416% for us to have a 0 NPV. 7.8416% for us to have 0 NPV. Any doubts on this? Next point. Hence 7.8416% of fixed cost. 7.8416% of fixed cost is equal to 7838. 7.8416% of fixed cost is equal to 7838. Any doubts on this? Be very clear on the logic. Let's not worry about the computation. What I am trying to explain is, if your annual cash flow falls by some number, that number is equal to the percentage increase in fixed cost. The fixed cost, I'll round it off and write it as 1 lakh. Our answer is slightly varying because of rounding of differences. We get 99,954. You can round it off to 1 lakh figure. The fixed cost is 1 lakh. Fixed cost is 1 lakh. Any doubts on this number? Any doubts on fixed cost of 1 lakh? Okay. Next, estimated annual unit sales. Next, calculation of annual units sold. Calculation of annual units sold. This is more of costing. Calculation of annual units sold. Point number 1. Annual contribution equal to annual contribution equal to annual cash flow plus annual fixed cost. We are going in the reverse order. Annual contribution equal to annual cash flow plus annual fixed cost. The annual cash flow is 57,500 and annual fixed cost is 1 lakh. Overall 157,500. Overall 157,500. Your contribution per unit is 140. 60 rupees is the variable cost. You do kind of reverse working and get that 140. Contribution per unit is 140. Units sold is 157,500 by 140. 157,500 by 140. One 57,500 by 140, 1125 units. Any doubts in this? For the last part, break even point. Break even point is equal to fixed cost by contribution per unit. Break even point is equal to fixed cost by contribution per unit. One lakh by 140, fixed cost by contribution per unit. Seven one four units. Fixed cost by contribution per unit 714 units. Any doubts in this? Any doubts in this? Okay, now listen, this BEP is basically costing BEP in cost. Listen for a minute. This BEP is costing BEP. From a finance point of view, I can also write BEP like this. BEP is equal to annual cash flow plus fixed cost by contribution per unit, and this annual cash flow is something at which I will generate 0 NPV. So break even point can be understood as no profit, no loss. I can also understood at the level at which I am going to generate 0 NPV. I am going to generate 0 NPV. To generate 0 NPV every year I have to make profit of 49,662. Every year we have to make profit of 49,662. I add that fixed cost of 1 lakh. Divide by 140. This is normal costing, and this you will write at which NPV will be 0. At which NPV will be 0. So we are looking from a financial point of view. If you are going to generate 0 profit every year, project straightforward rejection, because there is no inflow at all. It's only initial outflow and 0 inflow. So that is costing. Costing is bothered about fixed cost by contribution per unit. From finance point of view, it's fixed cost plus the cash flow at which I'll have 0 NPV. Cash flow at which I'll have 0 NPV. Institute answer is only 714, but I can give an alternate answer like this. I'll have to sell 1069 units to attain 0 NPV. To have 0 NPV, we need to sell 1069 units. 714 units will not help us in generating 0 NPV. 1069 units are to be sold to have 0 NPV. Clear? 714 units and 1069 units. Can we proceed? Just give me a minute. Okay. So we are done with, listen, expected value is done, standard deviation is done, coefficient of variation, RADR, CEF, sensitivity analysis is done. Next I have something called as decision tree, which I will do later on. I will move to something called as this Helios model is also done as part of our normal analysis. The Helios model is basically standard deviation. Concept 7, 8 we will see it later. Now I will go to a concept called as Z value. Now There's something called as a normal distribution table. You could have seen this somewhere. There's something called as a normal distribution table, and there's a chart like this. This normal distribution table works with something called as a Z table, and this has a 50% probability. This has a 50% probability. Now, in a practical world, I look at the past data of 20 years of a stock. I looked at the past 20 years data of a stock. I had the returns. Now listen for some time. Return and probability are the two things I need. So let's assume I want to analyze the time taken to go to my office. So I looked at the last 100 days data. I calculated the standard deviation. I calculated the mean. I calculated the standard deviation. I've also calculated the mean. Now somebody asks me, what is the probability that you will reach your office in 5 minutes? I can get that with the help of the Z table. If somebody asks me this question, I need only two numbers, standard deviation and mean. To do standard deviation, you need historical data. For example, I look at India's played 100 ODIs in the last 2-3 years. I look at the score for the 100 ODIs. I calculate standard deviation and I calculate something called as mean. With this two data point, if somebody asks what is the probability that India will score 250 runs, the conditions don't remain same, players change, so there it may not be that much applicable. But if I have to go to my office, the conditions broadly remain the same, the route which I take remains same. So the mean time was something like 10 minutes and the standard deviation was some 3 minutes or 4 minutes, the average variation. With this two data point, I can answer anything which you asked. If you are going to ask me what is the probability that will reach your office in 1 minute, technically I can say there's no problem, it's not possible. The Z table will give you an answer. The Z table will give you an answer called as 0.001, some mathematical number. It is kind of not possible to reach in 1 minute, but Z table will finally give you some number. So Z table is something which can be used to compute any probabilities, and it's not a concept only in SFM. You will use this in costing. I'm not sure whether it gets used in FR or some other place, but anywhere you want to attach a probability to something, you will use something called a Z table. So this is something in statistics. In statistics there are two things, one is Z table and interpolation. You should be very clear on these two. Interpolation we use it at, I cannot say at what place I'm going to use it, but interpolation can be used and Z table can be used. Now listen, let's take from an NPV point of view itself. I calculated NPV is 20,000. Standard deviation is 2000. How do you calculate standard deviation? How do you calculate NPV? All of this we have seen earlier. All of this is already seen. Now there is a table like this. This place is called as Z is equal to 0 and NPV equal to 20,000. Whatever mean you have got, whatever mean you have said, NPV is that number. Below this 50% chance, above this 50% chance. If somebody wants to know what is the probability that we will generate an NPV of more than 20,000 rupees, there's a 50% chance. What is the probability that NPV will be less than 20,000? Again a 50% chance. So max is saying 50% chance for both. 50% chance for both. There's a 50% chance that your NPV would be greater than or equal to 20,000. There's a 50% chance that it can be lesser than or equal to 20,000. Both have a 50% chance. Any doubts till now? Any doubts? Now, somebody wants to know what is the probability my project will generate negative NPV. My project will generate negative NPV, which is less than 0. It is going to be not a probability of 50%, it's going to be lesser, it's going to be a lesser number. So how do we calculate that is what we are going to see here. To do this, I will first write something called as target NPV. There's something called as a target NPV. Let's assume the person wants to know that what is the probability that we will generate an NPV of more than 24, less than 24 doesn't matter. There is a number I want first. He says he wants an NPV of more than 24. I'm not really bothered about it. 24 is the number. 24 is the number. Now, 24,000 will come here. If it's 1614, it will come in the left side. If it's 2430, it will go in the right side. Against this, there has to be a Z value. Against this there has to be a Z value. You said 24,000 you need. I'm not bothered whether it's more than or less than. I'll come to more than or less than in some time. But you want an NPV of 24,000, I'll write a Z value for this. Now what is that Z value is? Target value minus expected. Expected is your expected NPV divided by standard deviation. Target value minus expected value by standard deviation. What is the target we had? 24,000. What is the normal expectation? 20,000. What is the standard deviation? 2,000. So Z is going to be 2 times. Z is going to be 2 times. Like this, my target time to reach office is 12 minutes. Average time is 10 minutes. 12 minus 10 divided by, it can be a positive answer, it can be a negative answer. If it's a positive answer, it goes to the right side. If it's a negative answer, it will come to the left side. That is why I was saying, if Z is more, it will go to the positive side. So if NPV is more, it will go to the positive side. If NPV is less, it will come to the negative side. Any doubts till now? Any doubts till now? So Z is equal to 2. Z is equal to 2. Any doubts in this? Any doubts in this? Now, there is a probability for every Z value. First, you will have to compute the Z value. After computing the Z value, I will look at the probability. The probability is available in page 305 and 306, which is the last few things. Now listen, Z is 2.0 here. Z is 2.0 and the probability is 0.9772. Probability is 0.9772. So for Z of 2, the probability is 0.9772. The probability is 0.9772. Now if somebody wants to know what is the probability that the value will be less than, it is 97.72%. If you want to know what is the probability that you will generate an NPV of more than 24,000, it's the remainder of 2.28%. Sorry, not even 2.28%, it is, yeah, 9772, sorry, yeah. See, basic thing is that Z of 2 corresponds to 0.9772. Z of 2 corresponds to 0.9772 of probability. 9772 of probability. That 9772, if you say less than 24,000, 97.72% is the answer. Whatever you are computing, see, what indirectly I am trying to say is, this entire portion is 97.72%. How 97? 50% of this. And this part is balance 47.72%. The balance 47.72%. And the remainder goes to this side, which is, so there is a 2.28%. I'll now read it in multiple ways. There is a 2.28% probability that your NPV will be more than 24,000. There is a 47.72% probability that NPV will be between 20 and 24. NPV will be between 20 and 24. There's a 97% probability that NPV will be less than 24,000. NPV will be less than 24,000. You can do this for anything. Now, if somebody wants to know what is the target, I give a target of, let's assume 18,000. 18 minus 20 divided by 2000, Z is minus 1. Z is minus 1. Minus 1 of Z corresponds to 0.1587. It corresponds to 0.1587. Just a minute. Okay, take it. So here to here is 0.1587. This part is 0.1587. Just give me a minute, I think. Okay, sorry. So the balance part, the left side portion is 1587. Whatever value you are calculating is the value to the left side portion. The left side portion is 0.1587 and the balance is the remainder one. The left side portion is 0.1587 and the balance, whatever is left over, is the 84 point some number. Now, if somebody wants to know lesser than 18,000, Answer is only 15.87%. More than or equal to 18,000, the answer is going to be some 85%. The answer is going to be 85%. I would want you to read a little bit about this more, because there's something called as a single tail value and double tail value. I'll maybe doing this when I do derivatives, but it's preferable you read a little bit about this, not from SFM solving point of view, not from costing solving point of view. It is something which is good to know. I don't know where it will get applied. It can get applied at any point. Even in the real world, you may want to apply this. If you see, if somebody gives me the TCS return for the last, okay, I have Sensex returns for the last 10 years. I can calculate mean, I can calculate standard deviation. Using mean and standard deviation, I can attach a probability for the future. I can attach a probability for the future. So anywhere you have historical data, you can calculate mean, you can calculate standard deviation, and you can also attach a probability. Now I can go to the extent of saying that the probability that the value of this building will exceed 2 crore is 2.5%. The probability that the value of this building will be around 1 crore 50 lakhs is 10%. Will be this. So I can attach a probability like this to anything which you want, with an understanding of this Z table, Clear? Any doubts on this? Any doubts on this part? Very, very critical area. I am not sure. See, in SFM it will be used in this place. I'll use it in derivatives valuation. In costing, it will be used in something called a CVP and uncertainty analysis. It will also be used in simulation. So, sorry, not simulation, it will be used in decision tree. So, multiple places this concept will come in. This concept will come in at multiple places. A very good concept to know, because if I have to explain in detail, see, Z table as a concept could be explained for some 6 hours, because there is something called as a single tail value, there is something called as a double tail value. How do you interpret a single tail value? How do you interpret a double tail value? Area of the left side, area of the right side. So all of that will take a lot of time. So time constraint, we can't, and you need not do much, and you need not even do Google. Go to YouTube, search how to compute Z table. You may have a video of some 30-40 minutes, just because that 30-40 minutes will be explaining from the basic till the end. Today I am not going to explain you from the basic till the end, because I don't have that much time to focus on Z table computation. So you need to spend that 30 to 40 minutes time, just listen to it, that's all. That will kind of take care of your Z table analysis. It's a very good concept to be aware of. It's very good concept to be aware of, because you can attach probability to anything. You can attach probability to anything with the help of Z table analysis. Let's do a problem on this now. Let's go to question 8. ABC is considering the renovation of its department at a cost of 10 lakh. Its incremental cash flow is very sensitive to the economic conditions. The firm thinks that the probability distribution of incremental cash flow exists for each of the 4 years. Cost of capital is 10%. Expected annual incremental cash flow, NPV, standard deviation, probability of negative NPV, less than 1 lakh, at least 4 lakh. Go through the question. Okay, first I'll have to calculate NPV and standard deviation. We have done this earlier. Now we are going to do the NPV and standard deviation calculation. Now the question is giving event, probability and the cash flow. First thing is asking, what is the expected annual incremental cash flow, NPV and standard deviation. So if cash flows were given, I explained you that what we do is we calculate the weighted average cash flow for every year and standard deviation also for every year. Working note 1, computation of working note 1, computation of weighted average cash flow and standard deviation. Computation of weighted average cash flow and standard deviation. See, wherever standard deviation comes, it is, I don't know the term, the first column can be different. Probability, product, deviation and PD square are the next 4. That is standard. The first one in this case is cash flow. Cash flow, probability, product, deviation, PD square. Cash flow, probability, product, deviation and PD square. Cash flow, probability, you can write in the side in lakhs. We'll do this in lakhs, otherwise there will be so many zeros to write. Cash flow, probability, product, deviation and PD square. Probability, product, deviation, PD square is a standard which has never changed. We keep writing the same stuff. Probability, product, deviation and PD square is something which we never change. Cash flow, probability, product, deviation and PD square. What are the cash flows they have given? 8 with a probability of 0.1, 5 with a probability of 0.2, 4, 3. These are the various possible cash flows. This is the annual cash flow. Every year this is going to happen. Every year we are going to generate this cash flow. They are saying there are is very sensitive to the economic condition. If the first event happens, every year you will generate 8 lakh. If the second event happens, every year you will generate some 5 lakh. This will happen for a period of 4 years. This will happen for a period of 4 years. Product, deviation, PD square completed. The weighted average cash flow is 4.2 lakhs every year, and the standard deviation of every year is 1.5362. The standard deviation of every year is 1.5362. Weighted average cash flow is 4.2 lakhs. Standard deviation is 1.5362 lakhs. Standard deviation is 1.5362. $1.5362 lakhs. Standard deviation is 1.5362 lakhs. I am yet to come to Z table analysis and all. It is basically computing NPV and standard deviation. Any doubts till now? Working note 2. computation of NPV of the project. Computation of NPV of the project. Year cash flow PV. What's the discount rate given? PVF at 10% and DCF. You can write it as finally as normal number. The NPV is 3,31,400. That's the NPV we are looking at from the project. NPV is 331,400. NPV is 331,400. 331,400. Clear? Any doubts on this? NPV is 331,400. Working note 3, computation of standard deviation of the project. Computation of SD of the project. SD of the project. SD of the project. It will be year standard deviation. If you remember, this is what we had done. Year standard deviation, PVF at 10%, discounted standard deviation square. There's something called as independent approach, dependent approach, and this is what we had done as part of concept 1 and 2 of risk analysis. In concept 1 and 2, we learned how to calculate standard deviation. Year standard deviation, PVF. Now you cannot do an annuity and all, you will have to write separately for every year. You will have to write this separately for every year. I hope you remember this. We had done something like this, which is dependent and independent approach. Year standard deviation, PVF at 10%, discounted standard deviation square. Year standard deviation, PVF at 10%, discounted standard deviation square. if you put a total of DSD, that's the standard deviation if the cash flows are dependent in nature, and if you put a total and a square root, that's the standard deviation if cash flows are independent. There's a dependent cash flows and independent cash flows. We will take one of the approach and then complete the next part of the question. Either it is dependent cash flows or independent cash flow. I'll follow dependent. For the problem we are following this now, okay. 486820. That is the answer with which we will work, assuming the cash flow is dependent on each other for every year. If it's dependent, 486820. If they are independent, it is 244782. Can you proceed? Done? Okay, now listen. Now we'll go through the Z. See, now it can ask me for anything. What is the probability that the project will have negative NPV, positive NPV, less than, greater than? I can do any analysis provided I have these two numbers. The expected NPV was, how much we got? Yeah, 3,31,400, and standard deviation is 486. I'm assuming dependent. 486,820. Now I have done this for NPV. You can do this for any item which you want to analyze. If you want to analyze distance, time, marks, returns, anything you want, you need these two numbers, expected NPV and standard deviation. Now scenario 1, probability that project will generate negative NPV. Probability, scenario 1, probability that project will have negative NPV. Probability that project will have negative NPV. Okay, listen. My target NPV now is 0. I'm not bothered about positive, negative, greater than, less than and all. We'll see later. Target NPV is 0. Normal NPV is 331,600. 331,600. Okay, 331,400. That's my normal NPV. Then standard deviation of the NPV was 486,820. Now listen. I can write target time to reach office, normal time to reach office, and standard deviation of reaching office. These three could be the variables which I need. Z is equal to target minus normal divided by standard deviation. My target is 0, normal is 331,400, you give me a 2 decimal answer. I'll need a 2 decimal answer. It will be negative, positive, whatever the sign comes, you use that and tell me. How much is it? How much? Minus 0.68. Negative 0.68. Any doubts till this? Any doubts till this? Wait, I don't want you to write. I'll give you time to note it. 0.68. Now, the same thing I'm going to put it in a diagram. Just a minute. Okay, there is a z is equal to 0. At z is equal to 0, the NPV is 331,400 and probability is 50%. Probability is 50%. If NPV goes to the lesser side, probability will come down. If NPV goes to the higher side, probability will go up. Now, I have computed z is equal to minus 0.68. Now, we will go to that page. Minus 0.68 is 0.68, you will see in the top, 8 is this, 0.68. So, this is the second decimal and this is the first decimal. The first decimal comes here. So, it is like this: 0.340, 341, 342, 343, 344, 345, 346. It goes on like this. 0.68 is 2483. The value is 0.2483. It will be there in the printed material which you have. 0.2483 is the value for 0.68. Any doubts on this? Any doubts on this? That value is basically the left hand side. So, this is 2483. This together, the overall part is some 0.7617. If you want a breakup, this is 50%, 26.17%, and the balance portion is 24.83%. Now, if the question is saying what is the probability that project will have positive NPV, then I have to look at the right side, because positive is greater than, negative is less than. So, I don't know what the question asks. If they ask positive NPV, answer is 76.17%. If they ask negative NPV, answer is 24.83%. When I am doing calculation, I am not bothered whether they are asking me greater than 0 or less than 0. Do calculation, write the probability and then see what the question's requirement is. Is it greater than requirement or less than requirement? In this case, it's less than 0 requirement. It's less than 0 requirement, which is 24.83%. Any doubts on this? Any doubts on this? Now write till this first. Now write target NPV equal to 0. Target NPV equal to 0. Target NPV equal to 0. Normal NPV equal to 331,400. Normal NPV is equal to 331,400. Standard deviation 486,820. Standard deviation 486,820. Standard deviation 486,820. 486,820. Z is equal to target minus normal by, see, the objective is not to learn for this problem. The objective is being clear with the concept so that in a practical scenario you may use it elsewhere. Z is equal to target minus normal by standard deviation. Target minus normal by standard deviation. See, if you are way off from the normal, no, the Z will be a very high value or a very low, Z will be a very high value and it will reach closer to a 0% probability. You may end up reaching closer to a 0% probability if you are on the negative side. Positive side, you will reach closer to 100%. Z is equal to target minus normal by standard deviation. You put this chart, write everything, then I'll give you some pointers to interpret that chart. Do that Z, put the chart, be done with that. There's something called as one side value. You will learn it in derivatives. There's a problem there, but basic requirement is do a little bit of Google about it so that you are clear. Okay, now write few points. Z of minus 0.68, Z of minus 0.68, Z of minus 0.68 correspond to 0.2483, 0.2483 full stop. This would be the value, this would be the value to the left side of the tail. This would be the value to the left side. This would be the value to the left side. Just write till that. This would be the value to the left side. Next point. In case Z is positive, the probability will be more than 50%. In case Z is positive, the probability will be more than 50%. Probability will be more than 50%. And in case Z is negative, the probability would be less than 50%. Probability would be less than 50%. Next point. The question is asking for negative NPV in bracket less than 0. The question is asking for negative NPV in bracket less than 0. Full stop. Hence the final probability will lie to the left side. Final probability will lie to the left side of the Z value. Final probability will lie to the left side of the Z value. Clear? Any doubts on this? Okay, listen. There's something called as a single tail value and double tail value. I don't have the table in front of me as of now, so I will not explain it. I'll anyway do it in derivatives, but the requirement is, see, analysis everything will remain same, but how do you write the value based on a single tail value? It's a little different. For a double tail value, it's a little different. So how do I write the value will change. Next scenario. What is the next scenario they have given? Probability of, what is the requirement of the question? How much? Less than? Okay, less than 1 lakh. Less than 1 lakh. We will not be bothered about less than, plus, greater than and all. We will write the target as 1 lakh and do the question. Probability of less than 1 lakh. I am not bothered about less than or greater than at this point of time. Less than 1 lakh. Now write target NPV. Target NPV 1 lakh. Normal NPV. Target NPV 1 lakh. Normal NPV 331,400. 331,400. Standard deviation 486,820. Target minus normal by standard deviation. Target minus normal by standard deviation. Minus 0.48. Minus 0.48. minus 0.48, and let's get a probability for that. Minus 0.48 point 3156. Okay, whatever you calculate is the value to the left side. Whatever we are writing is value to the left side, 31.56%, and balance this side is 68.44%. Balance is 68.44%. 68.44%. Now I want to know whether it's less than or greater than, less than left side, greater than right side. Your final answer is, if you are looking at less than answer, go to the left side of the chart. If you are looking at greater than answer, look at the right side. When I say left side, right side, it is not from this center line, it is from this line. This is the point at which I will have to look whether the left side or right side. Now what is the requirement? Less than 1 lakh or more than 1 lakh? Less than 1 lakh. Final answer is 31.56%. The final answer is 31.56%. The probability of generating less than 1 lakh is 31.56%. More than 1 lakh is 68.44%. More than 1 lakh is 68.44%. The value is always the left side value is given in the question. What you get is the left side value. From the chart you get the left side, sorry, from the table you get the left side value, and if they ask less than, problem is over. If they ask greater than, then you will have to do the inverse part. Now this is something I use it for any area. Wherever probabilities are needed, bring this into picture. The moment you think about Z values, you will be in a position to answer any type of question on probabilities. If probability is needed. Okay, wait, before doing the next one, I want you to do this. Probability of generating NPV between minus 2 lakh and 3 lakhs plus 3 lakh. Generating NPV between minus 2 lakhs and plus 3 lakhs. Between minus 2 lakhs and plus 3 lakhs. NPV between minus 2 lakhs and plus 3 lakhs. Again, really not bother about whether it is less than, greater than and all. First get me the Z value for minus 2 lakh, Z value for 3 lakhs, and let's write that first. Let's first get that and then we will see it. Minus 2 lakh is already done, no? Okay, no, we didn't do. Sorry. Let's do Z is equal to, target is minus 2 lakh. Plus 3 lakh. For both, get me the Z value. Minus 2 lakh and plus 3 lakhs. Get the Z value. minus 1.13 and minus 0.06. You can also tell me the probability for these two from there. Minus 1.13 is how much? Minus 0.06 is how much? 1.09 you get? 1 point? Okay, sorry, my mistake. Second one? Okay, 109 is how much? 1.09. Look at the values for 1.09 minus 1.09. 1.09 is okay, 13, yeah, sorry, 13. 1379 and 0.06 is 47. This you get it from the probability table. I can do this for any kind of a scenario I want to. I got Z value. For a Z there is a probability 0.1379 and 0.4761. 0.1379 and 0.4761. Any doubts till now?
It's like so individually we calculate, right? So if you want NPV,
I'll come to that. I'll come in the chart itself. It will be easier to understand in the chart. Any doubts on 0.1379 and 0.4? I am not even bothered whether it is less than, greater than. I have not come to any of this as of now. Any doubts on 0.1379 and 0.4761? Now, this was for 331,400. We had 3 lakh. We also had minus 2 lakhs. For minus 2 lakhs, we got an answer of 13.79%. 13.79%. For 3 lakh, we got an answer of 47.61%. The area to the left side is 47.61%. The area to the right side, if you want, you can calculate the balance. The area to the left side is 13.79%. The area to the right, if you want, you can calculate it. Now, what I want is area in between these. Between plus 2 lakhs, sorry, between plus 3 lakhs and minus 2 lakh, which is nothing but 47.61% minus 13.79%. That will be the probability of in between. Listen, less than 3 lakh is 47.61%. Less than negative 2 lakhs is 13.79%. If you want in between, this minus this number will give you the in between probability. You will get the in between probability. In between probability is 47.61 minus 13.79. .83.82%. 33.82%. Less than 3 lakhs, left side. Exact 3 lakhs you cannot calculate. It's either less than or greater than. If you want less than 3 lakhs, it's left side answer. If you want greater than 3 lakhs, it's the right side answer. So less than 3 lakhs, see whatever table values you have, those are for the less than. So less than 3 lakh is 47.61%. Less than negative 2 lakhs is 13.79%. In between is the difference. Any doubts on this? Any doubts on this part? What's the last one? They have given the scenario. What is the scenario? Greater than how much? Okay, at least 4 lakh. Use target NPV 4 lakh, normal NPV so much, standard deviation, Z value, probability, then see whether the left side is the answer or the right side is the answer. The table will give you the left side answer. The table will give you the left side answer. The last one is 4 lakhs. Target NPV 4 lakh. Normal NPV 331,400. Standard deviation 486,820. Z is what is the Z value you get? How much? 0.14, which corresponds to 0.55. Okay, this is the answer if you are looking for less than value. If you are looking for at least is greater than 1 minus this answer. Less than value will be this. The left side of the left side of that line is this answer. The balance, if you want, you subtract 100% minus this. Now, I am not explaining this more from the point of view of probability for this. It's more from an understanding. Practically, this will be very useful if at all somewhere you want to get a probability. If somewhere you want to develop a probability, this is very useful. 55.57% is the probability of project having less than 4 lakhs. Greater than 4 lakh answer is going to be 44. Greater than 4 lakhs. They have asked at least 4 lakhs, so that is 44.43%. Any doubts on this? Clear? Can we proceed? Okay. Now I'll move to the last part, which is simulation. I'll first explain what is simulation. Listen. In risk analysis, we are basically trying to understand what can go wrong. That is our basic premise by which we are trying to analyze. Now, I have historical data, or I did some analysis, I got all the probabilities, everything is done. But I don't know what will happen in the project. So, there is something called as an exercise called as simulation. What is simulation is you are just trying to simulate what is going to happen to the project. In a practical world, the number of trials can be even 20,000, 10,000, 5,000. There is something called as a random number table. What is random number table is, it can be a 2-digit random numbers or a 4-digit random numbers. There is no logic on the numbers, it is just random numbers. So, you will pick a random number and see. For example, if I go through this question, when I read you will understand there are 3 factors: demand, CFAT and likely investment, for which some probability analysis is given. Okay, I will run an exercise, I will get a random number. Let us assume random number is 25. If it's 25, 25 will correspond to one of these numbers. It will correspond to, so you will do the first trial. In the first trial, random number is 25, which correspond to 45,000 of demand. Then there will be a separate random number for cash flow. It will correspond to some. Then there will be a separate random number for investment. It will correspond to this. So like this, you will run this exercise multiple times. When you run this exercise multiple times, you will get demand in every trial. You will get the CFAT in every trial. You will get the investment in every trial. Combining these three, you will get NPV. Combining these three, you will get NPV. Like this, you will get 10,000 different NPVs. 10,000 different NPVs, and take a normal average of that. That is technically the expected NPV of the project. There's no logic. It's no logic. It's random number. You're just trying to say what can happen to the project. The project can have 37,500 of demand, 3 of CFAT, 24 lakh of investment, 82,500 of demand, 9 of CFAT. So multiple options are possible. So you run this experiment. After running the experiment, you will get NPV for every experiment. NPV for every experiment, and an average of that is called as average NPV or expected NPV of the project. In class, we may do only some 8 trials, 10 trials. In practical world, Excel can do any number of trials we want. So there is no end to it. I simulate this for 10,000 times. When I simulate this for 10,000 times, I kind of understand. See, you can do an average of it, you can also do a median of it, you can also do a mode. So you can practically understand where you are going to end up mostly, because 10,000 is a huge database. In the 10,000 database, I can kind of understand where I am going to finally get into. This is one way which is called a simulation. If you don't want to do simulation, you will do a weighted average. I can do a weighted average of demand, I can do a weighted average of CFAT, I can do a weighted average of investment. That is what we have been doing till now. In simulation, you will do an experimentation, and based on experimentation, you get to know where you are going to end with. Simulation is a separate area altogether for old syllabus of costing. It's not there in new syllabus, but it's old syllabus of costing. You have simulation as a separate area altogether. In simulation, we just try to understand what is the possible outcome, because a lot of uncertainty. So considering these uncertainty, what is the possible outcome is what we analyze here. Let's go through question 9. Go through this question. Go through this. Okay, now in order to do a simulation experimentation, we fit something called as a random number table. There's an Rn table to be fitted in. Once we fit that Rn table, we will do the experimentation. Now, a random number table can be fit if you have probability distribution. If you are saying there's no probability distribution, you cannot do the simulation itself. So I'm going to fit random number for demand, cash flow and likely investment, because there's a probability for all the three. Working note 1, Rn table for demand. Working note 1, Rn table, random number table for demand. Working note 1, random number table for demand. You will need 4 columns: demand, probability, cumulative probability and random number. Demand, probability, cumulative probability and random number. Demand, probability, cumulative. Demand and probability copy paste from question. demand and probability copy paste. Obviously it has to add up to 1, the probabilities. Demand and probability copy paste from question. Okay, cumulative probability is the cumulative values of the probability column 0.05, this plus 0.10, cumulative values of the column 2, 0.15 plus 0.20, goes on like this. Cumulative values of the probability column, cumulative values of the probability column, cumulative values of the probability column, clear? Okay. Now I'll see something here. This is my random number series. This has been taken from random number table. It can be a 2-digit random numbers, it can be a single digit random numbers, it can be a 4-digit random numbers, whatever be it. What are the number of digits in random numbers? How many digits you see? 2. Okay, now listen. If it's 2-digit, I want all of this to be in 2 digits, okay? Let it be a 0, 0 added up together. Let it be a 0, 0. Now listen. If it is 0.05, my random number starts from 0, 0 to 04. What is 04 is number before 05. Number before 05. Next random number is starts from 05 to 14. What is 14 is number before the 15. Number before the 15. Then it starts from 15, 34, 35 to 64, 65 to 84, 85 to 94, 95 to 99, 95 to 99. Sometimes it could be a single digit random numbers. Let's assume if it's a single digit. In this question it's not possible because there is a number. If it's a single digit, then you will have it like this. Then it is like 0 to 0 itself, because 0.1 is one number, 0 to 0. Next would have been 1 to 1, 2 to 3, 2 to 3, 3 to 6, 6 to 8. What you basically see is whatever number, number before that. If it's 0.9, the number before that is 8. 0.7, number before that is 6. 0.4, number before that is 3. Now I am doing anyway for 2-digit random numbers. So we had the probabilities with 2 decimal. 05 means it ends with 04. 15 means end with 14. 35 ends with 34. 65 ends with, sorry, this is 64. 85 ends with 84. 95 ends with 94. And 100 ends with 99. Now listen, why we are fitting like this is, what the experimentation says is, you will give me a number saying random number is 85. I'll say if it's 85, the demand will be 75,000. If you say me 85, the demand is 75,000. You will say suddenly the random number is 34. I'll say demand is 52,500. If you say 25, the demand is again 52,500. If you say 05, the demand is 45,000. If the number comes out to be 28, demand is 52,500. That is what random number does. You fit in a random number table like this, you give me a random number corresponding to that, I'll give the demand. No, not transportation. No link with transportation. It's simulation. This is a separate area on simulation. No link with transportation. So you will have to fit 2-digit random numbers. You look at the probability and a number before that. Any doubts in this? Fit the random number. Like this, we'll have to do it for every element. Fit this random number table for demand. Write the random numbers. like this we'll have to fit random number table for CFAT, random number table for investment. Any doubts on this? Next, random number table for CFAT, RN table for CFAT, RN table for CFAT, RN table for CFAT. The question would give the first two columns, copy them, 3, 5, 7, 9, 10. Even if it is 0.10, write it as 0.10 itself, don't write it as 0.1. I need 2 decimals. We need 2 digits post the decimal, so make it that way itself. Now tell me what will be the random numbers. 0, 0, there's no point and all, 0, 0, 2, 0, 9. If you write as only 0.1, you will get confused. That's why 0.10, let it be 0.10. Then 10 to 29, 32, 69, 72, 89, 92, 99. Any doubts on this? 0, 0 to 09, 10 to 29, 30 to 69, 70 to 89, 90 to 99. Then random number table for investment. Like this, the probability distribution can be for any number of parameters the question wants to give. We have done this for CF18 now. Any doubts on this? Third one is for investment. Again, this is something which can be practically developed. You develop this model and put it in Excel. Excel will simulate. Start doing this exercise. You can develop this and post this. It will start. A random number as such is used for sampling purpose. When an audit is done and if you have to select few samples, it can be done through random number tables. You run a random number query, the system will generate some numbers and you take the sample out of that. The samples, whatever we are choosing, you can end up taking it through random numbers. Zero, 0 to 24, 25 to 74, 75 to 99. Any doubts on this? Okay. Now we will start computing NPV. Next, working note for computation of NPV. You may need some 10-11 columns. Working note for computation of NPV. We may need some 10-11 columns. Manage space properly. Computation of NPV. Now write experiment number. First column is experiment number. Experiment number. Listen, the question has talked about 10 trials. I have given only 5 data, so just change it as 5 trials. We'll do only 5 trials. Experiment number is 1, 2, 3, 4, 5. 5 experiments we are going to do. Experiment number 1, 2, 3, 4, 5. Experiment number is 1, 2, 3, 4, 5. Random number for demand. That was the first item we fitted in. Random number for demand. Random number for demand. Now listen, there's no set rule that the first row is for demand. It's random, so you can do anything you wish to. So this numbers will be for demand. The second set of numbers is for investment. Sorry, for CF80. Third set is for investment. So random number is 28, 57, 60, 17, and let me write it as 06. Let me write it as 06. 28, 57, 60, 17, 06. And then demand. Go to that random number and tell me 28 means what is the demand. 28 is, if I go to 28, I find it as 52,500. 57 means how much? 60 means again 60,000. 17 means how much? And 606? 45,000. Okay, that is my demand. Now I can run this experiment for any number of times I wish to. Random number for demand, and demand is so much. Random number for demand, and demand is so much. We did this experiment for demand. So I have found that the demand is going to be these numbers, 52,500, 60,000. Then random number for CF80. Random number for CF80. Random number for CF80. 19, 07, 90, 02, 57. Now if you change the order and saying that I will do first CF80 demand, answer will undergo a change, because all this is random. There's no set logic that answer has to remain same. Listen. To have better accuracy, the number of experiments should be very high, something like 1000, 10,000, 5,000, so that there is no huge variation. Random number for CF80, and this CF80 will correspond to some number. 19 corresponds to 5, 7 corresponds to 3, 90 corresponds to 2 corresponds to 3, 57 corresponds to 7. Then Rn for investment. Rn for investment and investment. Random numbers are 18, 67, 16, 71, 43. The random number for investment is going to be, the values 18 is 8, 16, 8, 16, 8. Okay, last one is also 16, 8, 16, 8, 16 and 16. Okay, now it becomes 5 different scenarios for NPV calculation. It's like 5 different scenarios for NPV calculation. Any doubts till this? Any doubts on this? Okay, now listen. Okay, let me write it as, you can write this as 8 lakhs, 16 lakhs, 8 lakhs, 16 lakhs and 16 lakhs. This is my outflow. This is my outflow. This is the outflow. I'll need some 10, 11 columns. Any doubts on the investment number? Now listen. Every year my inflow is demand into the CFAT. This is my annual inflow. Annual demand into annual CFAT. CFAT is per unit dimension. So this is what I'm going to generate every year. Annual demand into annual CFAT. Annual demand into CFAT per unit. Sorry. Annual demand into CFAT per unit. Annual demand into CFAT per unit. Annual demand into CFAT per unit. That's every year inflow. See, the random numbers can be for multiple. I could do it for fixed cost, variable cost, selling price, discount rate. So different scenarios will get different answers. Any doubts on annual inflow? Is the life given? I think it got missed out in the question. You take life as 8 years, okay? Life as 8 years. Discount rate? Okay, both got missed out. Just write life is 8 years. Discount rate is 10%. Life 8 years, discount rate 10%. Listen, NPV is inflow minus outflow. Present value of inflow is, can you tell me 8-year annuity factor at 10%? 8-year annuity factor at 10%. 8-year annuity factor at 10%. 5.33? Okay, you multiply that 5.335. Your annual inflow into 5.335 is the present value of inflow. Annual inflow into 5.335. And inflow minus outflow is NPV. Into 5.335. Into 5.335 and NPV is inflow minus outflow. NPV is the final one. Inflow minus investment, which is your outflow. This is the NPV number, some positives, some negatives. This is a very small experiment sample. 5 is a very small number. I should ideally do it for a longer, the sample size should be high. We have done it only for 5 samples. 5 is a very limited number. And you can take an average of that. That's average NPV. There's no probability and all, it's just a normal average. We will take an average of the last column, which is your NPV. Average of the last column, which is NPV, 336505 is the number. Average is 336,505. 336,505. The range is very high. Sometimes you get plus 24 lakhs, somewhere you are getting negative 7 lakh. We'll just put an average of that. 336,505. We have done this experiment 5 times. Practically I can do it for any number of times because Excel will do the calculation. Our job is not there to do anything. Excel will automatically do all of this. Construction of random number, we will have to see. I need the data, that's all. Once the data is in, we will be in a position to fit this. Any doubts in this? Can we proceed? We'll just answer this part now. Any doubts in this? Now let's look at the requirement of the question. Assess the least likely cash flow and the corresponding value of investment. Now write least likely cash flow equal to, of that 5 experiment, which is the lowest one? Which one? Annual inflow first. Yeah, right. Least likely cash flow equal to 157,500. Least likely cash flow is 157,500. Least likely cash flow 157,500. 157,500 colon corresponding investment value equal to 16 lakhs. Corresponding investment value equal to 16 lakhs. The question talks about 10 experiments. We have stopped with 5. Corresponding investment value equal to 16 lakhs. I changed the question as 5 experiments. Corresponding investment value equal to 16 lakhs. Any doubts on this? What is the recommended investment if the least CFAT materializes? They are saying the least is what is going to happen. How much should I invest? How do I answer this? What is the maximum recommended investment level if the least CFAT materializes?
Probably the present value.
Yeah. See, if this happens, I am going to reject the project. But somebody tells me that the investment is only 840,263. If the least CFAT materializes, I can invest 8,40,263. Nothing more than that. If somebody is going to say the least is going to happen, then the maximum investment is 840,263. 840. Next, maximum investment level for least CFAT equal to maximum investment level for least CFAT equal to 840,263. Maximum investment for least CFAT equal to 840,263. 840,263. 840,263. 840,263. Clear? And the last one is expected NPV is 336,505 average. 336,505. Expected NPV is 336,505. Clear? With that, we will end this session. Next class would be next weekends. We'll see over the weekend when we can keep the class.